Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be covering Starbucks, ticker symbol SBUX. Now, before we get started, let's take a quick look at my portfolio dashboard. As we can see right here, my total invested for the portfolio is $28,897, and my current value is sitting at right under $36,000. That gives me an unrealized gain of $7,000 or 25%, which is actually the lowest total return I've had in the past couple months. Now, like I do always mention, this is not something that I am concerned with and does give me a buying opportunity of certain stocks within the market, so a little bit of a decline is not too bad in the long term. Also, I definitely won't be surprised if in the coming weeks we'll see even more of a decline in this portfolio value, but again, over time it's going to even out and it's going to start increasing once again. Now, in terms of holdings, I haven't bought any new positions recently, still sitting at 24 holdings, and the dividends I've received this year are sitting at $168.24. As a reminder, this is not financial advice and I'm just merely sharing my opinions on this channel. So without further ado, let's jump into Seeking Alpha and take a look at Starbucks' recent performance. Since the start of this year, they're actually down 8.75%. If we look at their 1 year growth, we can see they're down 18.24%. Now, if we do compare that to the market, we can see the S&P 500 is up 4.14% since the start of this year and actually had a recent decline. And if we look at the total 1 year return, we can see that it's up almost 20%. However, it's not as bad in the 5-year time frame. It's actually up 16%, not including, of course, dividends being reinvested. And for the past 10 years, it's up 145%, which is pretty solid performance. And it actually did peak in 2021. Now, the recent decline in the stock price is actually not all that bad for investors, especially if they're trying to start a new position in Starbucks or to add on to their existing position of Starbucks. It does give a discounted price of which to buy into. If we look at their 52-week range, it's actually very close to its 52-week low, and it was actually a little bit closer more recently, but it's since climbed up from $85 per share. After the company got fairly overvalued in 2021, we can see that it had a pretty sharp decline all the way down to June of 2022, in which it climbed again and has since started to fall back down once again. Now, in terms of their valuation, we can see here that their price to earnings ratio is actually at 23.68. And if we look at their forward-looking price to earnings ratio, it's even lower at 21.77, which is very solid for this company. And the reason I say that is because if we look at their 5-year average, we can see that it was at 30.51 and 35.79 for their forward-looking price to earnings ratio. So that's about a 22% discount to their 5-year average. Now, as I mentioned in my video on Nike, not all stocks will continue to command such a premium going forward, but we can expect Starbucks to start picking up their valuation again once they have some solid earnings under them and get past some of this controversy. Now, I'm not going to get too far into the controversy surrounding Starbucks recently. If you have been keeping up with the news, you've definitely seen your fair share about it, but there have been some boycotts basically against Starbucks, and of course, it is affecting their bottom line just a little bit, but I think on a macroeconomic scale, on a global scale of their business, I don't think it's going to be as important to their performance in the long term. Now, of course, doesn't mean we won't see a further decline in the next couple quarters or even couple of years, but I think, like I said, in the long term, this company is going to do just fine, and they're a very strong, well-run company. So assuming alone that they start picking up their valuation and getting towards that 30 price to earnings ratio once again, we can definitely see a very strong price appreciation in the stock price as long as the fundamentals stay the same. Now, in terms of their financials, their revenue has been increasing over time, aside from the dip in 2020, which is very common for a lot of the companies that we've seen. And even though 2021 was their highest price that we have seen the past couple of years, we can see that 2023 had much higher revenue, so you could argue it's at a much better valuation now than it was before. Now, one thing that is really nice to see about Starbucks is that their basic weighted shares outstanding have actually been decreasing over time. In 2019, they were sitting at over 1 billion, sitting at 1.2 billion, and now fast forward 2023, they're sitting much lower, 1.1 billion, and they're going to keep buying back these shares, and hopefully the management does keep buying back shares at these lower valuations because it'll both help push the stock price up but also increase ownership of the individual stakeholders in the company, or shareholders I should say. Now, Starbucks is a dividend growth machine, and we can see that very evidently in their dividend per share. So over time it's been increasing very rapidly, and their payout ratio has actually been decreasing overall over time. So right now it's sitting at about 59 at the payout ratio, 59%, which is a little higher than what I like to see in most companies, but I think it's still very much in a comfortable range for this company. And if you look at September of 2020, that was definitely the worst pay ratio they've had recently, but 207% is of course very bad, but 59 is very manageable for Starbucks to handle. If we look at the company's total debt, the company unfortunately does have a very high amount of debt, and that's going to be really bad with these higher interest rates. And also if we look at their net debt, it's actually not covered that well by their cash equivalents, their liquid assets. I think with the amount of locations they have to open up, it's very common for them to continue to have to take out more debt over time. I really hope the interest rates do go down because that'll definitely help push the stock price back up to where it should be. Now, right now, a lot of this debt might have some pretty good interest rates because it was done before the hikes had started, but if they have to refinance any loans, this could be pretty detrimental to the company's business. Taking a look at what I think is a very important metric, it's their free cash flow per share. And we can see that in 2020, it was extremely low, barely sitting at 10 cents per share. And in 2019, it was actually sitting significantly higher at $2.65 per share. Fast forward to 2023, at least it is sitting higher at $3.20 per share. But we can see here that in 2021, it was sitting significantly higher at $3.84. What I would like to see over time is this graph kind of becoming a more linear sort of progression for them. They can continue increasing that free cash flow per share each and every year because, of course, dividends do come out of their free cash flow. So if it's not steady, it's not consistent, that's going to play around a lot with their payout ratio. Now, based on that, we can tell that the reason that payout ratio was so high back in 2020 was because of how low their free cash flow per share was during that year. Now, it does seem to be an anomaly. I don't think they're going to continue having such a low free cash flow per share going forward, but of course, we definitely don't want to see that if we're investing inside a company. If we do take a look at their dividend scorecard, we can see their dividend yield is sitting at 2.6%, which is pretty nice. Some people like it a little bit towards the higher range, so over 2% I would consider to be pretty moderate. Moderate to moderate high dividend yield. Anything over 4% would be pretty high. And their pay ratio is sitting under 60%, which is pretty safe. I would love to see this under 40%, of course. And Starbucks' most recent dividend raise was actually about 7.5%, so it's a little bit lower than its historical 5-year growth rate, but it's not too bad at all, actually. I just do wish it goes back to those double-digit growth rates pretty soon. Now, taking a look at their dividend yield for the past 5 years, we can see several instances where the dividend yield was as high as it is right now. So right now it's sitting at about, 2.6%, I would say. And then back in 2022, it's sitting pretty similarly at 2.65%. And also back in 2020, we can say the same thing. Now, at times where there was overvaluation of the stock and the stock price dipped down afterwards, we can see how low the dividend yield was actually sitting at 1.57%. And the same can be seen here in 2023 once the stock price started increasing once again. Now, if we do consider dividend yield theory just by itself, we can see that potentially this could be undervalued right now. Based on that, the dividend yield is pretty high and you'd be getting a pretty good initial starting yield for your holding. Now, because of their aggressive dividend growth history, we can see that if you bought this company 10 years ago, you would currently be sitting at a yield on cost of 6.4%, which is very solid. Now, the way yield on cost is measured is it's measured based on your current yield divided by your stock price when you first purchased the company. So as long as you keep holding the company and the yield keeps increasing, your yield on cost will continue to go up over time. Looking at their growth metrics, the revenue growth year over year is fantastic at 11.46%. And if we look at their expected forward-looking growth, we can see it's sitting at almost 10%, which is very solid for this company. If they're able to execute on this level, I do think that the stock price will see some nice price appreciation. Of course, the valuation will go up in turn. Compared to their 5-year average, both metrics are sitting higher, but we'll have to see how they perform this year in order to know. Graphing Starbucks price to earnings ratio over the past 5 years, we can see how much lower it's sitting than back in 2021 when the company was significantly overvalued. In 2021, it was sitting at a price to earnings ratio of near 190. And if we fast forward to right now, we can see that it's sitting pretty low at 23, going forward 21 price to earnings ratio. Now, for the past couple years, it actually has been sitting at around the same valuation, and the same thing can be said before 2021. But based on this big jump that we see here, it's still a pretty good price and a pretty good valuation to get into, in my opinion. Now, like I do always remind everybody, just because a company is sitting near its 52-week low doesn't actually mean that it's undervalued, and just because a company is sitting at its 52-week high doesn't mean that it's overvalued. Looking at the market right now, we've seen countless examples of this. Companies such as 3M, which have just continued to tank down, Medical Properties Trust. And then we also have companies on the other side of the spectrum like Nvidia that has continued to trek up no matter what. Always do your due diligence before investing and consider what you think the company is going to do in the long term. Basically how it's going to perform, how it's going to execute, and if it's going to be able to continue to grow looking forward. In the short term, a company might swing 20% down or 20% up, but if you're planning on holding a company long term, you're not really focused on those short term swings. Now, as always, that does bring us to the end of today's video. I just want to thank you guys all for watching. If you did enjoy this video, definitely subscribe to the channel and comment down below what kind of companies you want me to cover next or any different content you want to see on the channel. If you haven't yet watched my latest video, check it out right here. And if you want to see my dividend income for the month of March, check that video out right here. Thanks again for watching, and I will see you in the next one.